Morgan Stanley missed on earnings today, reporting $1.39 of earnings per share versus $1.53 expected. The primary reason for this miss was a worse than expected drop in investment banking revenue, 55% down from last year. Overall, company revenue is down 11% and profit is down 29% from a year ago. Despite these steep declines, total expenses have barely budged. You might think that given such lackluster performance, the company would be working to cut costs or grow its business, but instead they announced an 11% increase in dividend. Morgan Stanley CEO James Gorman also made several odd remarks during the call that add to my hesitation on the stock. When one analyst asked him what parts of the business might suffer in a recession, Gorman said, quote, "For our business model, I think we fare relatively well, and the evidence for that is, our confidence in the future." A while later, he reiterated that position by saying, "This dividend increase and share buyback program is a statement of confidence of A, our capital position, and B, the resilience of our business model." Now, I'm a finance guy with a background in physics and math, and it's a bit of a red flag, call it an orange flag, for me to hear a CEO use their own confidence as evidence that their claim is true. I mean, if confidence was evidence, then the financial crisis would never have happened. And he used the same phrasing twice. That's not the only thing he said, though. Later in the Q&A session, another analyst asked essentially the same question. Why not use their capital to grow the business? Aren't dividends a suboptimal use of capital when Morgan Stanley's peers don't have excess capital? Why not use the excess capital to take market share during this time? Gorman answered by talking about past acquisitions, which aren't relevant to the question, which was about future uses of capital, not past uses, and dividends, which also aren't relevant to the question. In fact, they're exactly the opposite of growing a business. Dividends are returning money to shareholders where they can no longer be used to grow any aspect of the business. He mentioned a few trite generalities about investing in digital, etc., but even those he qualified by saying that those were not new initiatives. Also, just listen to these statements he made during his response. Listen, there's always opportunities, environments to pick up share. We're in a bit of an uncertain world. I don't think this is the time to be overly aggressive, personally. I like the fact we have excess capital. He talked about some financial ratios and metrics. He said he thought they'd been prudent. He talked about keeping safety margin rather than going after another $100 million in revenue. He said, we're not trying to win the game right now. He said, we'll be opportunistic, but we're not going to be greedy. Now that all sounds rather reasonable, except for the fact that he's answering as if the question was about sacrificing their safety margin of capital to grow the business. But that's not what the question was. The question was about why not sacrifice, or not even sacrifice, but just not increase dividends, and instead use that capital to grow their business when they're in a uniquely competitive position relative to their competitors. And what about that aggressive statement? I'll repeat it. He said, we're in a bit of an uncertain world. And then he said, I don't think this is the time to be overly aggressive. What happened to all that talk about confidence in their capital position and business model? Another one of Morgan Stanley's executives even equated capital and strategy, which means they should be very confident in their strategy. Yet now Gorman is saying the world is too uncertain to go after market share, even though they have a uniquely competitive opportunity that their competitors don't have. Honestly, there were so many contradictory statements in this earnings call that I gave up on trying to track them all, but these, in my opinion, do not reflect well on Morgan Stanley's leadership, and they make me doubt the stock as a good investment. Now, to be fair, I also have to mention the good things Morgan Stanley has going for it. Has a 3-year track record of setting record ROE figures, that's return on equity. And this year, while not a record, is still above 10%, which is relatively good. Also, Morgan Stanley announced a larger share buyback program than they had in 2021, which is a fantastic use of capital for 3 reasons. The first is that share buybacks are not double taxed like dividends are, which makes them inherently more efficient. The second is that $1 of share buybacks can potentially increase the stock market cap, or the stock's market cap, by up to $5, which may allow Morgan Stanley to compensate employees more efficiently than paying cash. The third is that Morgan Stanley's stock is significantly cheaper than its 52-week high, which means $1 today buys more MS stock than it did a year ago. So those are the positives. What do you think of Morgan Stanley? Do you like the stock? Do you hate it? Let me know in a comment below, and I'll see you guys next time.